Now, more on the expected rate cut. Whether policymakers opt for a half percentage point cut or a quarter point, it remains to be seen. Joining me now to discuss is Vance Ginn. He's the president of Ginn Economic Consulting and former chief economist at the Office of Management Budget. Vance, how are you doing today?
Hey, I'm doing well. How are you, Don?
I'm doing well, too. Let me ask you this. Why is the Fed cutting rates, right? The economy is chugging along 3%. Unemployment, not historically high. Inflation, 2.5%. So it seems like inflation is slowing and the economy is not doing terribly bad. So why do we need a rate cut?
Well, the argument is, and I don't think that they should actually cut today, but the argument is that inflation is moderating. It's getting closer to their 2% rate that they would like for it to see. And also that the labor market is weakening. The unemployment rate's going up. Job creation is not as brisk as what they initially had thought, and it keeps being revised down substantially. So there's a lot of concern about the weaknesses in the economy, and they're trying to lower interest rates in order to incentivize people to go out and get loans, to invest in the economy and other things. But my big concern here, Don, is that, inflation still remains pretty hot. I mean, if you exclude food and energy, which we all buy, of course, but that's up 3.2% year over year. And GDP growth is still running pretty hot overall. And we're still having jobs being created, even though there is some weaknesses there. And at the end of the day, the Federal Reserve can only control inflation. It can't control the labor market.
So is the concern the labor market here? Is it slowing too much? Is that the biggest concern?
I believe so. And some have tried to make the case that this is a strong labor market, but at the same time, they're arguing the Federal Reserve should be cutting interest rates. You can't have it both ways. Either we have a strong labor market, or the Federal Reserve needs to keep interest rates higher, or they need to cut interest rates and the labor market is weak. My view has been the labor market is weak, but the evidence really shows the Federal Reserve doesn't have much influence on what happens in the labor market. What really it controls is its balance sheet, which remains bloated, over $7 trillion on its balance sheet, and that they control inflation when they print more money. So I'd rather them focus on those things rather than cutting the interest rate today.
Tell us what you think will be the impact of a half a percentage point or a quarter percentage point from the economy's perspective and from the consumer's perspective.
Yeah, Don, I mean, the federal funds rate, which is the one that they have a target on, right now it's 5.25 to 5.5%. So some say it could be as much as 50 basis point cut, which would get it down to about 5% at the higher range. What that will do is then influence a lot of other interest rates throughout our economy across the yield curve, meaning that mortgage rates could go down. You could see car loan interest rates go down. Other things for people to hopefully spend more money is what the idea is. But we also got to remember that consumers are strapped with cash right now. I mean, they basically are strapped from cash. They basically have a lot of credit card debt of over $1 trillion. They've got a lot of mortgage debt as well, even as valuations have went up. And so it's going to be very difficult for them to come in and say, you know what, with all the other inflation that's going around, I'm going to spend more money on cars and on mortgages and other things. And instead, I think that they won't have the ability to. So we'll see what happens. But ultimately, Don, this will influence a lot of other interest rates throughout the economy.
So from what you're saying, are you worried about a flare-up in inflation if we do get a cut?
I am, Don. I mean, this is one reason why I'm saying that I don't think that they should cut now, because inflation remains too high. And so what I would rather see them do is cut their balance sheet. Their balance sheet is what they buy of debt and other assets throughout the economy, and they manipulate a lot of those interest rates and other assets throughout the economy. And it also increases inflation. If they were to cut that, that would be able to control inflation more and reduce the distortions that are happening throughout the economy. And I think it would also help the labor market in the process, instead of trying to cut interest rates, increasing the money supply, and putting more inflationary pressures. Because one of the things that we need to learn from is the past. And from the past, we saw in the 1970s that they cut interest rates too fast when they saw inflation was moderating. And you know what happened next? Inflation spiked again, even higher than it was before. So I'm very concerned that this might lead to another situation of that, where we repeat the same mistakes of the past, expecting a different result, which is the definition of insanity.
So in your opinion, you're saying that the Federal Reserve today should hold the interest rate as it is right now, no cuts, not even a 25% basis point cut.
That's my take. And I know I'm just a few of those who are saying that, but I'm really concerned in looking at this in the history. The economic evidence that's out there is that there's not a good reason to cut today. Some, like I said, some will say that it's because of the labor market, but I just don't feel like the Federal Reserve has the tools to can do much with the labor market. That's from other real variables throughout the economy of whether or not businesses are profiting, whether or not consumers are investing and consuming things. And so that's about the real part of the economy, not from the money supply or interest rates that are on the nominal side of things. And so I'd rather them keep interest rates unchanged and cut their balance sheet instead.
And another point I want your comment on is if the Fed indeed cuts rates today, is that going to limit the Fed's ability to respond to future economic downturns if a recession occurs?
Well, it's a great point, Don, and I think it's something that should be under consideration by the Fed as they're meeting today, is to say, you know what, if we may be in a recession now as the labor market's really slowing down and everything else. But if it's going to be a recession in the near future, as some other indications like the yield curve was negative for years, it's finally been positive again, and that usually can indicate a recession is forthcoming. Will they have the tools necessary to deal with that sort of recessionary factor instead? And that's another good reason not to cut today. Now, they will have more room. Even if they cut 50 basis points today to 5%, they've still got 5 percentage points that they could cut. Because remember, before the pandemic back in 2020, the interest, or after the pandemic, they cut it down to 0%. And so they could cut it a lot more to try to boost the economy. But again, we've got to really consider that the Federal Reserve longer term doesn't have influence on real variables throughout the economy and the labor market and things of that nature. What it does have control over is inflation. And so if they lead to more inflation during a recession, that's a bad situation for Americans, because now you have fewer jobs and your wages, as you just lost your job, won't be able to keep up with the inflation that's going all around you. And so that's really going to hurt a lot of Americans.
Okay, we just about have around 30 seconds. Can you tell us if lowering rates, we know households are in a lot of debt, right? Do you think that's going to help with the households that are in debt?
Well, it depends, right? Which is the economic answer, but it really does depend. I mean, if they are already locked into a longer term interest rate, whether it's a car loan or a mortgage over the last couple of years when interest rates have been a lot higher, it won't help them unless they want to go out and refinance. But if they want to buy something new, that could help them down the road. Also, credit card rates could go down some depending on how the other interest rates are throughout the economy. So it really depends, but I'm hopeful that what we can see instead is real growth in the economy. We need to unleash the economy by having less government spending, lower taxes, and lower regulation, and ultimately a lower Federal Reserve balance sheet.
All right, Vance, thank you very much for your time today.
Thank you, Don.